Okay. Now, revenue and expense recognition, it's according to accrual basis of accounting. Alrighty? So that means revenue and expenses can be recorded. Revenue and expense can be recorded without an exchange of cash. That is neither a requirement under US GAAP or IFRS. We do not need an exchange of cash. Alrighty. So good news is both IASB and FASB, we've basically converged. There's some subtle differences, but when we record revenues is basically identical whether it's US GAAP or IFRS. Remember, the word revenue implies it was earned in the ordinary course of business. The word gain, though, implies that it's something that's not part of our core business. Gains and losses, as a general rule, come from the sale of non-inventory items like PP&E or maybe investments. Okay, revenues come from the sale of inventory or our service, whatever type of business we're in. Okay, so gains and losses as a general rule come from the sale of non-inventory items, PP&E, investments, or losses can come from mandatory write-downs or write-offs, okay, due to the accounting rules, all right? So gains and losses, non-core, revenues, and most expenses are from the core business unless you're told otherwise. All right, so very important, we are not cash basis. Revenue is recognized according to accrual basis system of accounting. Okay, so the revenues and expenses are recognized independently of the timing of the cash flow. It doesn't matter if we've received the cash or paid the cash, okay? And I'll go through lots of examples in just a little bit. Alrighty. Now, accounting standards for revenue recognition. Good news again, the standards, US GAAP and IFRS, are almost exactly the same. Both are what we call principles-based approach. Okay, a principles-based approach, which I'll show you. So how do we know if we're going to book revenue? 5 steps. You do not have to memorize it. You are not writing an essay. Just be very familiar, but you don't have to memorize it because you're not writing an essay. It's about recognizing, okay, not memorizing. There's got to be a contract, an agreement between the buyer and the seller, okay? What is the obligation? What is it that we have to do? Is it to sell a good or a service? Okay, what is it that we have to do? What's the selling price? Okay. Can we allocate the transaction price to the performance obligation if it happens over time? If it happens over time, if it's something that's going to happen over time, an extended time, okay? If it's going to happen over time. All right. As a general rule, we'll recognize the revenue as we satisfy the obligation. Put down C, long-term contracts. Okay, many times we satisfy the obligation at one point in time. I deliver the good. But when we construct a building, that happens over time, as you're going to see. All right, so we've got to have an obligation, an agreement, and we have to reasonably believe we're going to get paid. So, recognize revenue as you satisfy the obligation is synonymous with as you earn it. As you earn it. Okay, as you earn it. Have you done what you're supposed to do to earn it, and do you reasonably believe you're going to get paid? Okay, so you have to have, what is your obligation? Sell goods or sell services? Okay, what is it we have to do? Okay, if it's selling goods, have they been delivered? Have we transferred title? Have they been delivered? If it's services, are they substantially complete? Okay, the price, can we determine the price? It's got to be measurable. We've got to know the price, so you can't book revenue, obviously. Okay, revenue is going to be recognized as we satisfy our obligation. So as a general rule of thumb, when it's goods, it'll be transfer of title. Transfer of title or risk of loss. If it's services, it would be as completed, as completed. And constructing a building over a long period of time would be as completed. So goods, transfer of title or risk. Services, as we complete the services. Alrighty. Now, accounting treatment. Sometimes we deliver goods and get paid immediately. So the accounting treatment, let's say we deliver the goods and get paid immediately. Then what happens? We get cash, revenue goes up. And guys, just as a sequence of events here, okay, whenever we book a revenue or a gain, that makes your profit go up, which makes your retained earnings go up, which in turn makes your equity go up. We'll get there. But anytime we book a revenue or a gain, profit goes up, which makes retained earnings go up, which eventually makes equity go up. Here I just went directly, I showed it directly, the impact on equity. Our balance sheet is in balance. What if we haven't been paid yet? What if we've collected in example number 1, but example number 2, we have no cash yet. We haven't collected yet. Then instead of having cash, I'd have an account receivable. Revenue would go up. I've accrued for it. There's no cash yet. Example number 3. In example number 3, we receive cash before it's earned. Somebody gave us money and we haven't earned it yet. We receive cash, but it hasn't been earned yet. What does that do to the balance sheet? Well, obviously you have cash, but there's no change to equity yet. Liabilities go up. Sometimes it's called unearned revenue or deferred revenue or deferred credit. Sometimes they call it a refundable advance. There's all kinds of synonyms. But if you receive cash, a client gives you a deposit, but you haven't earned it yet, the cash goes up, which makes your assets go up, but there's no change to equity yet. It's a liability until you earn it. Sometimes that liability is called unearned revenue, UER, or DR, deferred revenue, or even sometimes it's called a refundable advance. Okay, upon earning that revenue, we then do what's called an adjusting entry. Okay, upon earning that revenue, there's no change to assets. We already got paid. But the liability goes down, the unearned revenue goes down, and what goes up in its place? Revenue. So no change to the left side, but the right side changes in that the liability goes away, and in its place, we record the revenue. Alrighty, so those are common examples when it comes to revenue. Has it been collected? It's earned and collected. Sometimes it's earned, but not yet collected. Or sometimes we collect, we haven't even done the work yet. 3 common examples you'll see. Alrighty. Now, for revenue to be recognized, it's got to be highly probable we're going to get paid. And you've got to satisfy the performance obligation. Okay? Satisfy that performance obligation. Now, sometimes it's easy, sometimes it's not so easy. Okay? To prove we've satisfied the performance obligation. Okay. Now, some examples are pretty easy. Okay. In a simple contract with only one deliverable at a single point in time. Okay. So you deliver the goods. Alrighty. We deliver the goods. So it's a single item. We deliver the goods called for in the contract. Okay. As soon as we deliver the goods, we're going to either record cash or an account receivable. That goes up. Okay, whether you record cash or accounts receivable, our revenue goes up, which makes our equity go up. And the inventory comes down, which makes our asset come down. We take the inventory off our books. We record instead a cost of goods sold, which makes our expenses go up, which makes our equity go down. Okay, so if it's a relatively simple contract, all right, we transfer the legal title, the possession. Okay, the customer has accepted the asset. They've got the risk and reward. We have the right to payment. We deliver the goods. It's very simple. record either cash or accounts receivable, and record your revenue, okay, which will make your equity go up, and get the inventory off your books. It becomes an expense, cost of goods sold. Okay, by recording the inventory, the asset comes down. By recording the cost of goods sold, expenses go up, which makes equity go down. Balance sheet is in balance. But it's not always that simple. Sometimes we have more complex, like long-term construction contracts, where it's going to take us multiple years to fulfill our obligation. So the goal is to record this revenue as we meet our obligation over time. So we will call that later on percentage of completion. We'll get there later on in the course. Okay, but when you record the revenue, is simply the performance of goods or services, or is it something more complex, like constructing a building that may take 5, 10, or 15 years? Okay, and then we give you some examples of complex contracts. Now, this is only an initial introduction. We're going to see this in greater detail later. But let's take a look at some examples. You ready? Long-term construction. We're going to construct a commercial building. Forget all the details here. Big picture, what happens when we're going to construct a building? How do we record things when we're going to construct a building? Okay, what they do is they're going to record the revenue in proportion to which the work is done over time as the work is done. Okay, so they will record the revenue little by little over time. So even though the construction of the building, take a look at this, requires lots of different things like engineering, okay, some plumbing, some electrical, interior finishing. At the end of the day, when it comes to recognizing the revenue, they don't treat each of those goods or services. They cannot treat each of those as a distinct source of revenue. They don't. It's a single performance obligation. And the preferred rule is to use something called percentage of completion. They will record that revenue little by little over time as the work is done. They don't record the revenue when some plumbing is done. They don't do it that way. Okay? The preferred rule is to use something called percentage of completion. So look at this. Excellent example illustrating what's called percentage of completion. You ready? We're going to build this building. We're going to construct the building for $2 million. Stop right there. There's our contract price, $2 million. They expect to incur costs of $1.7 million. We have a reliable estimate for total cost. We have a reliable estimate for total cost. Okay, so our estimated costs are $1.7 million. That gives us, therefore, estimated profit of $300,000. We have estimated profit, therefore, of $300,000. Okay? We're going to record the revenue, expense, and profit in proportion to the work completed each year. We're going to record the revenue, the expense, and profit in proportion to the work completed each year. How do we get that proportion? Current year costs divided by total estimated cost. So we'll book everything. Since we have a reliable estimate for total cost, we're going to use something called the percentage of completion method. So in this example, how much work did we do in year one? $1,190,000. Take the current year cost, $1,190,000. Divide that by the total estimated cost, $1.7 million. What percent does that get us? 70%. We will record 70% of the revenue, so $2 million times 0.7 1,000,004. 1,000,007 times 0.7, 1,190. 300,000 times 0.7, 210. A little bit of the revenue, a little bit of the expense, a little bit of the profit. Okay? So basically, this is the same amount that would be recorded using percentage of completion under the old accounting standards. Just as an FYI, the Converge standards do not make specific use of that term, but that's what they're doing. Recording the revenue, expense, and profit in proportion to the work as you complete it. As you complete it, you've earned it. Okay, so as it's completed, it's earned. Okay, so as you earn it, you book it. Alrighty, just put a note. We will cover this later, but note, if there are not reliable estimates, cannot use percentage of completion. You cannot use percentage of completion. Now, we will learn about that in another class, but I just want you to note what we're covering here assumes that we have reliable estimates, okay? It's got to be measurable. If it's not measurable, you can't book the revenue. What needs to be measurable? Both the revenue and the costs need to be measurable, or you can't do this type of accounting, okay? By the way, the numbers we just covered here, we're going to use again in a subsequent example. So remember, contract price, $2 million. Estimated cost, $1,007,000. Estimated profit, $300,000. Okay, now the example continues. Now we're going to change the facts. Assume that ABC's contract is still worth $2 million, but they get a bonus of $300,000, but if the project is completed within 2 years. Well, they have limited experience with these types of contracts. There are many factors outside their control, so they're not sure. They are not sure if they will earn that bonus, okay? Therefore, what do they do with the bonus? It cannot recognize any of the bonus as revenue in year one. Why? It's not probable that it's going to be earned. It's not probable that that's going to be earned. Okay, so if it's not probable, you can't book it. All right, so that's a rule of conservatism. A rule of conservatism. If we're not sure we're going to earn it, if that's not probable, then you have no business booking it. Simple enough. Okay, we change the facts once again. Here we have a change to the contract. A change to the contract. It's called a modification. All right, we have a modification to that original deal. What was the original deal? $2 million selling price. $1,007,000 was our estimated cost. We estimated a profit of $300,000. Okay, so those were the original facts. How are they modifying the contract? So at the beginning of year 2, how are they modifying the contract? Well, take a look what it says. The contract, they say, listen, we're going to change the building floor plan, and now the price is $2,200,000. So the new price is $2,200,000. And the $300,000 bonus will now be paid out so long as we think we could do the work within 2.5 years from initiation. And they do believe that they'll be able to recognize the bonus now. They believe it's probable. Now, getting paid the bonus is probable. That changes everything. So now the contract price has been changed to $2,200,000. Plus we have the bonus that we believe we're going to earn, $300,000. So now the total selling price is $2,500,000. Okay, $2,500,000. Alrighty, $2,500,000. Now, they tell us in the facts, you ready? Because of the changed floor plan, because of that changed floor plan, the costs are going to change as well. Take a look at this line. The costs are going to go up by $150,000. Okay, so the cost was $1,007,000. But now due to the change, we expect another 150. So that's $1,850,000 is our total estimated cost now. What do we think our profit is going to be now? The difference between the $2,500,000 and the $1,850,000. The profit now that we're estimating would be $650,000. $650,000. So the question is, when there's a change in the contract, what do we do? Well, what we do is utilize something called a cumulative catch-up basis. We do not restate prior years. We leave the prior year alone. So in the original example, we booked 70% of all three of those numbers. We booked $1,400,000 of revenue, $1,190,000 of cost, and $210,000 in profit. In the original example, in the prior year, okay, in year one, what we booked already in year one, going back to the original example, which I think was example number 2-2. Okay, so this is per example 2-2. Okay, per example 2-2. We do not restate what we did in year one. We leave that alone. So what do we mean by this cumulative catch-up basis? You ready? Put down C next page. What the hell do we do in year two? What happens to year two now that we have a change to the contract? And this was on January 1 of year two. Okay, beginning of year two. Well, let's see what happens on the next page. It's a cliffhanger. I'm so excited. What happens? You ready? We'll take a look now. In year one, how much cost did we incur in year one? $1,190,000. There's no change there. That's actual. That's what's been recorded. But the total estimated cost, though, has changed. It's no longer $1,700,000. So what we did do on the prior page was take the $1,190,000 divided by $1,700,000, and we got that 70% number. That told us how much revenue, expense, and profit to book in year one. What we're saying now is, hey, that $1,190,000 is really relative to the new amount, $1,700,000, plus the $150,000. The $1,700,000 plus the incremental cost of $150,000. Total estimated cost now is $1,850,000. So now the percent complete is 64.32%. Alrighty. Now we apply that to the brand new information. Okay, the brand new information is this information: the total selling price, $2,500,000. The total estimated cost, $1,850,000. The total profit, $650,000. So what we do now on a cumulative catch-up basis is say, wait a second, and we're just going to do the revenue number, not the cost and the profit. Let's just focus in on the total revenue. Alrighty. So now the total revenue number, $2,200,000. The contract price change, plus we think we're going to earn the bonus, $300,000. So the new revenue number is $2,500,000. So we take the $2,500,000, multiply that by 64.32%. The $2,500,000 times 0.6432, 64.32%. Well, we should be recording $1,608,108 of revenue. How much, although, was already recognized in year one? $1,400,000. So how much more revenue do we now need to record on this cumulative catch-up basis? That's where they get the 208, 108. So in year two, at the beginning of year two, when we modify the contract, now we will record on a catch-up basis on the date of the contract modification, January 1. I'm making up January 1. They just said in the facts, they just said at the beginning of year two, I'm making that specifically January 1. It could have been January 10th, January 30th, I don't know. But for simplicity, I'm throwing in a date. Okay, so on January 1, year 2, we now book revenue an incremental amount of 208, 108. That's what we mean by cumulative catch-up basis. Alrighty? The converged standards, by the way, the converged standards, again, it's called principles based. There's lots of disclosures required now. Okay, what are the terms of the contracts with the customers? Okay, what are the balances and what's the timing, okay, of the collection and the performance and all that kind of good stuff? All of that is now required to be disclosed. Okay, so lots of disclosures. What do we have to do? What do we have to return if we don't do the work? What's unearned, etc. Alrighty. Now, expenses. When do we record expenses? Expense recognition. Okay, expenses are recorded as incurred, not when bill is paid. Okay, we are not cash basis, we're accrual basis. We apply something called the matching principle. Okay, the matching principle. Alrighty. An expense, the definition is some kind of decrease in an economic benefit during the period. Okay, we utilize something. Now, what I want you guys to do is set up for me at the bottom of the page. Now you got to be thinking more sophisticated than the average person. Okay, anytime we incur a cost, we buy something, we use something. Sometimes the cost will get capitalized. We buy something and the asset goes up. No expense yet. Why not? Because we have a probable future economic benefit. So sometimes we buy something, and when you hear that the company capitalized the cost, that means they booked an asset, not an expense yet. Why? Because they have a probable future economic benefit. Okay? So, examples of that would be things like inventory. That will eventually become cost of goods sold when we sell it. PP&E will eventually get depreciated over time or as we use that equipment. Okay? So the expense will be matched with the period it helps to generate revenue. Okay? So when a cost is capitalized, that means the asset, there's no expense yet. There's a probable future economic benefit. Inventory is an asset. Eventually, it will be an expense called cost of goods sold. PP&E is an asset. Over time, as we use it, we'll depreciate it. So when UPS buys a truck, that's not an expense. The truck is an asset. We will then expense that truck over the period in which it generates revenue for the company. Okay? Now, sometimes with a cost, we expense it immediately. Expense immediately. That's something called a period cost. Sometimes the cost is expensed immediately. It's not capitalized. Okay, there's no reason to believe it has a future economic benefit. And the accounting rules today are pretty strict in telling you there are certain things you're going to expense today, things like SG&A, interest as a general rule, okay, selling, general and administrative, interest, research, money you spend to research, maybe not development, but research, we'll get there, okay. So selling, general, administrative, financing costs as a general rule, your interest, your research, that stuff does not get capitalized. This stuff gets expensed immediately. You do not defer the expense to the future, but when you capitalize, that means you are deferring the expense to the future. Okay, you're deferring the expense to the future when you capitalize a cost. Okay. Now, expenses and losses are not synonymous. As a general rule, most expenses are operating. When you hear the word expense as a general rule, that's operating. Okay, there are some expenses though, like interest if you're not a bank. There are exceptions, like interest, which is generally non-operating if you're not a bank. When you hear losses, you immediately think non-operating, okay? But as a general rule, when you hear the word expense, you think operating. But there are exceptions. That's an ugly looking exception. Let's try to make that a little bit neater. Certain things are called an expense, but they're probably not operating. The example would be interest, unless you're a bank. If you're a bank, then interest income and interest expense are both operating. Assuming you're not a bank, that's non-operating. And whenever you see the word loss, you think non-operating. A loss generally comes about because the selling price for non-inventory was less than something called its carrying value, which we'll get to later, carrying value. Alrighty? But for our purposes, we record expenses according to the matching principle, not when something is acquired. Okay, we record the expense in the period in which it helps to generate the revenue on the income statement. Okay, certain expenses, though, we call period costs, things like selling, general, and administrative. Okay, they are expensed immediately in that current period. Alrighty, now classic example, inventory. Inventory is an asset on the balance sheet, not expensed until sold. We will cover inventory in great detail in another class. I just want to point out, first year of operations, this company buys lots of inventory. Please notice the cost per unit. We're in a rising price environment. We'll cover that later. We bought 13,750 units at a variety of different prices. You ready? Here's a very important number. It's called cost of all goods available for sale. Cost of goods available for sale. $324,100. Okay, this is an asset on the balance sheet. All this inventory we bought sits on the balance sheet as an asset, and it's not expensed until sold. Okay, how many units did they sell? 9,100. But where did these 9,100 units come from? Where did they come from? First ones in or last ones in? Where did they come from? Well, look what they tell me. The ending inventory is from the most recent purchases. This is what was not sold down here. Up here is what we sold first. When what's sold is the quote-unquote old units, that's called FIFO. First one's in, first one's out. We'll cover that later. Alrighty? So, step number one. What did we sell those 9,100 units for? $30 a unit. Here's my sales revenue. That is independent of LIFO, FIFO. It doesn't matter. That has nothing to do with sales revenue. LIFO, FIFO only affects the cost of goods sold. That'll impact your cost of goods sold and your ending inventory. But it has no impact on your sales revenue. Okay, what we need to do is the following then. We bought $324,100 worth of stuff. What did we sell and what didn't we sell? So cost of all goods available for sale, $324,100. What did we sell? What's unsold? Well, we are presuming first ones in, first ones out. I sold 9,100 units. Where did they come from? First ones in, first ones out. So I sold 2,500 of the first quarter's units, then 35,550. If you add those two together, what do we get? Well, 6,050 units. Well, if we sold 9,100 and 6,050 came from the first and second quarter, then we can infer of the third quarter batch of 4,200, we must have sold 3,050. Agreed? Okay. Now, We keep track. These units in the first quarter cost 20. These units in the second quarter cost 22. These units in the third quarter cost 25. So this is what we're going to say. The units we sold, we're going to say, hey, those cost us $204,350. Then you know what the unsold and ending inventory must be valued at? $324,100 minus that $204,350. Then what's unsold has to be $119,750. Or you could do it specifically. And look at the bottom, the ending inventory, the new stuff. Well, the third quarter, what was the total amount that we bought in the third quarter? 4,200. We're presuming we sold how many of those? 3,050. So how many are unsold? 1,150. And we didn't sell any of the fourth quarter batch. Okay, same result, different format. 119,750. Alrighty, we will cover inventory in great detail in the future. The important point is all the stuff what we bought is an asset on the balance sheet until it's sold. Okay, until it's sold, and that we will cover later. So now when we do an abbreviated income statement, we take our total revenue, 273, we subtract our cost of goods sold, brackets around it. That gets us our gross profit. Okay? Inventory methods we will cover later, so you don't need to sweat that right now. I just want to talk about choice of methods. Okay? A management decision, the choice of methods is very important. That is disclosed in the footnotes. In this example, the company chose FIFO in a rising price environment. So they sold the old, quote unquote, cheap stuff when prices were lower. So a lower expense will give you a higher profit. What's unsold are the quote unquote new expensive stuff. So your ending inventory is higher. Alrighty, so the method is very important. Now, sometimes they don't use LIFO, FIFO. Sometimes they use what's called the specific identification method. Okay? With this is the most accurate because there's no guessing. Did we sell the old ones or the new ones? There's no estimating. With specific identification, okay, with specific identification, which is generally used when the units of inventory can be identified, like automobiles. They have a VIN number. You know exactly what car you sold. Okay, it's very easy to identify exactly what unit you sold. But what if you don't sell cars? What if you sell pencils? Does each pencil have a VIN number? I doubt it. That's when you'd have to use, when it's high volume and a relatively lower cost, that's when you're probably going to use the LIFO, FIFO stuff, which we'll get into later. You might be selling the old stuff, you might be selling the new stuff. And anytime you see LIFO, you know it's got to be US GAAP. IFRS does not allow for LIFO. Alrighty? Both US GAAP and IFRS also allow for something called the weighted average method. All of this will be covered later. You do not have to sweat this right now. It will be covered later. Okay, so don't worry about it. It's just a brief introduction to LIFO, FIFO, weighted average. For all you really need to know for this class, inventory is an asset, sits on the balance sheet, and does not get expensed until the inventory is sold, according to the matching principle. Okay, but the amount for the cost of goods sold, if you're not using specific identification, then the amount that's in cost of goods sold versus ending inventory is dependent upon the method chosen. Okay, other expenses, issues, estimating expenses. Record expense prior to actual amount being known. Why would we do this? Why are we going to record an expense prior to the actual amount being known? Because of the matching principle. So some examples where we have to estimate expense. Doubtful accounts. Sales that are made on credit, a certain percentage of that we're probably not going to collect. Some of our customers are probably not going to pay us. Well, we can't wait to book that expense. We got to record that expense at the same time we record the revenue. So that necessitates an estimate. Okay? So what's that estimate going to be? So if the bad debt expense, okay, if the estimate for uncollectibles is low, then the expense is low, your net income is overstated. Okay? If the expense that you're estimating is relatively high, a higher expense, a lower net income. Alrighty? And on the balance sheet, we have the accounts receivable minus the allowance. That gets us the net realizable value. If the estimated uncollectible, let's say, is low, that also affects the balance sheet. A lower allowance is going to overstate the net realizable value of that accounts receivable. So we want to estimate that bad debt expense in the same period we record the credit sale, but the estimate is just that. So there's management bias. Anytime management is estimating expenses, management bias. Relative to the industry standard, is their estimate relatively low or high for that amount? Same thing with warranties. When an automobile is sold and they entice you to buy the car with a warranty, they can't wait to book the warranty expense until they actually find out how much money they're going to spend fixing the car. They got to estimate that future warranty and recognize it in the same period as the sale. Alrighty? So with warranties, same thing applies on the income statement. Let's say the warranty expense, let's say the expense percentage is relatively low. Then the expense is understated, your profit is overstated. And the set aside for the warranty, the liability, is understated. Okay? So, and let me just put that here. On the balance sheet, your liability would be understated. So if on the income statement that expense percentage is low, lower expense, higher profit, higher profit, higher retained earnings, higher equity. Your balance sheet, while your assets are not affected, your liabilities are understated, your equity would be overstated. Okay, so again, it's relative to an industry standard. Alrighty. Now, depreciation. When we buy PP&E, that's an asset on the balance sheet that'll be expensed over time. And there are various methods we can use to record depreciation. We might be using something called the cost model or the revaluation model. Okay? The cost model, US GAAP or IFRS. The revaluation model is IFRS only. Okay, but the cost model could be used under IFRS or US GAAP. Alrighty. So if they're using the cost model, you have your original cost on the balance sheet. It's an asset. Minus the accumulated depreciation, which is dependent upon method and estimates. And that gets you the net book value of the PP&E. Okay, the net book value of the PP&E. Alrighty, under the cost model, the asset is again on the books at cost less any accumulated depreciation. So if you accumulate your depreciation slower, let's say you accumulate your depreciation slower, the net book value of that asset's going to be higher. If your depreciation is lower, your net income is higher, your retained earnings is higher, your equity is higher. Okay, so again, the methods and the estimates are very, very important. Very, very important. Alrighty. Nonetheless, when you buy PP&E, that cost is allocated to several periods to match with the revenue it generates over time. Now, the choice of the method, the choice depends upon how a company expects to utilize the asset, but there's some management bias here. Okay, something called the straight line method is relatively aggressive. All right, relatively aggressive. They say, hey, we're going to spread out the cost less the residual value evenly over time. In the early years, as we'll see later on, the expense is lower, your profit is higher. Since the accumulated depreciation is accumulated slower, your net book value for that asset is higher. Conversely, if management says, hey, you know what, we think this asset will be more useful in the initial years, well, then that's relatively more conservative. Why is that relatively more conservative? Because you will accumulate your expense faster, which will give you a lower profit in the early years. If you accumulate your depreciation faster, the net book value of the asset will be lower. All of this will be covered in detail later. Depreciation we will cover in detail later. We're just setting you up for what the issues are, and that PP&E is not immediately expensed. Okay, if the company chooses an accelerated method, that's more conservative. Why? Higher depreciation expense and lower income in the early years. So, just setting you up for the issues we're going to look at. Folks, intangibles don't get depreciated. Intangibles, we use the word amortization. That's the term, spreading out the cost. Maybe it's a patent. Maybe it's a copyright. Maybe it's a trademark. I don't know. Maybe it's a franchise. All right, patents, copyrights, trademark, a franchise. If it has an identifiable useful life, it either has a legal life or a contractual life. If it has an identifiable life, we'll spread out the cost of that item evenly over that life. But sometimes intangibles have indefinite lives. They might go on forever. Things like goodwill, well, that's not amortized. Okay, another example might be a brand. Okay, all of that will be covered later. Okay, the demonstration of the depreciation method you can skim through. This we will cover later. Okay, so depreciation methods, all you need to know is management bias. All right, the math we will cover in detail later, so don't sweat that. All righty, but I do want you to know there are a variety of methods as we discussed. And the annual depreciation is going to vary depending upon the method we use. Okay, so all of this will be covered in the course later. You can skim it now if you want, but this is not the crux of this reading. Okay, so don't sweat the math here. You can look at the example and read it through on your own, but we will cover this together later on. If you want to get a jump on depreciation methods, you can look at this example, how we do straight line versus how we do double declining balance. Okay, you can read that through on your own, but I will walk you through this in great detail later. All right, so you do not need to sweat the details right now for that example. Okay, it's just there as an illustration. Just there as an illustration. Okay, I do want to point out that when it comes to depreciation, PP&E, which is going to get depreciated, we're not only concerned with the method, straight line versus accelerated, but we're also very concerned about certain estimates like residual value and useful life. Okay, two very important estimates. This is why we're looking at the footnotes. If your residual value or your useful life are higher that will make your annual expense lower. If your expense is lower, you know your net income is higher, which is going to make your retained earnings higher, which will make your equity higher. If you accumulate your depreciation slower, the net book value of that asset will also be higher. That will be covered later on. But these are also very important estimates. Don't worry about the math. Okay? Our job in this class is to understand the implications for financial analysis. Whenever we look at any estimates or methods of accounting, we're worried about management manipulation. Are they doing things that are relatively aggressive? In which case we would say the quality of the earnings are lower. Okay? Or are they doing things that we consider to be conservative, where we would say the quality of earnings is higher? You see, when the quality of earnings is lower, there's greater risk. You better increase your required rate of return. When you believe management is relatively conservative, hey, you believe there's less risk of investing in that entity. Alrighty? How do you know if an estimate is relatively aggressive or conservative? You got to compare it. Compare it to what? Other companies that operate in that same industry. Are you relatively conservative or aggressive? And how do we know if somebody's relatively conservative or aggressive? We look at the methods, the accounting policies, i.e. the methods, and the estimates are disclosed where? The methods and the estimates are disclosed where? The footnotes. Okay? They are also discussed in the MD&A. So that's the importance there. Alrighty, that's a lot of stuff. Now let's cover non-recurring items.